Please welcome to the stage moderator Sarah Shtylman, Perkins Coie, and panelists Jack McDonald, Ripple, Glen Sussman, Tassat, and Maja Lapcevic, Mastercard.
Well, good morning. It's great to be here. And I'm Sarah Shtylman. I'm a partner with Perkins Coie. I focus my practice on digital assets. I've been doing so for over a decade. I was actually the second in-house lawyer hired at Coinbase. Would have told you I'm never touching a billable hour ever again. And yet here I am, almost a decade later at Perkins Coie. And a huge part of my practice over the last 2 years has been in the stablecoin ecosystem. So I'm excited to be here today and share the stage with some folks who I will let them introduce themselves. But in doing so, I'd like to tee it up as, I think we all could probably spend an hour each talking about stablecoins. But as you introduce yourself, tell us what is keeping you busy in the stablecoin space in 2026.
Hi, I'm Maja Lapcevic. I'm part of our digital asset product team at Mastercard, and I focus on our crypto flows and digital asset commercialization. What keeps me up, a large focus of what we're doing is really embedding stablecoins into our network. So one of the products I lead is settlement for Mastercard, and that's keeping me up at night, or not keeping me up at night, just keeping me busy.
Hello, everyone. I'm Jack McDonald. I head the stablecoin business at Ripple. I am spending a lot of time with the intersection of institutional utility, really thinking about how stablecoin adoption has evolved and is evolving, and how that intersects with the regulatory environment. So I say that not just because we're in Washington, D.C., but there's just so much regulation that's happening globally that's really unlocking a lot of institutional demand. And so I think the future will be very different than the $0 to $300 billion growth of stablecoins that we've seen to date.
Morning, everybody. Glen Sussman. I'm the CEO of Tassat Group. For those who don't know, Tassat has been building and operating mission-critical blockchain infrastructure for regulated financial institutions for about 5 years. In 2025, we launched the Link ecosystem, or helped launch the Link ecosystem with our joint venture partners. Link is a tokenized treasury settlement and collateral network for digital asset institutions. And what's been keeping us busy is integrating stablecoin workflows into the Link ecosystem for 24/7, 365 on-ramps and off-ramps so that it can be truly end-to-end, always on. We're also working with a growing number of regional and community banks to see if we can better align the economic and commercial interests so that they can support and participate in the exciting growth of stablecoins.
Awesome. Well, Jack and Glen, you both touched on this a little bit on the sort of evolution of stablecoins. And when I think about where we've started and where we've come, I think Tether launched in 2014, and in 2025 we saw the Genius Act. And so there's been quite a bit that has impacted not only regulatory but product and market demand. So I'm curious how you all have seen sort of where we started and where we're going, and what's the same, what's different. What do you see as kind of the evolution of where we are with stablecoins?
I'll go ahead. I would say one thing that's been consistent, although it's changing, is payments. I think payments and stablecoins seem to increasingly go together, and it's one of those real-world use cases that people look at and say, aha, that makes sense to me. And back in 2013, 2014, it was a lot of cross-border remittances, and it was a savings vehicle for certain retail customers in high inflationary countries and whatnot. I think particularly post-Genius, we're seeing more and more institutions think about payments and the use of stablecoins or on-chain money. Ripple made an acquisition of a company called G-Treasury late last year, corporate treasury management software. Basically 1,100 corporate customers, brand names, the Black & Deckers, Coca-Cola, American Airlines. And those companies have not historically used digital money, on-chain payments, et cetera, but they're all very curious as to how to do that. And so I think with the passage of the Genius Act, it's a huge unlock for those type of customers who now have a signal that the water is safe to come in and to start to think about how they're using it. So still within payments, but a different type of end user. I would say the other big unlock that I'm seeing that's different today, I think a lot of the early crypto or stablecoin usage was around investing in crypto. So DeFi is still a huge percentage of stablecoin utility today, but we're starting to see more and more institutions using stablecoins as collateral or as a settlement token. Both of these peers on the panel here will, I'm sure, talk about it. And near and dear to us, another acquisition we made last year of a company called Hidden Road, a big prime broker that had both traditional finance and crypto customers, and thinking about how we can use stablecoins as a cross-asset class margining tool is really exciting. And again, the passage of Genius Act and some of the pronouncements from the SEC recently around a 2% haircut for stablecoins is really paving the way for traditional finance customers to start thinking about stablecoins as really a dollar substitute and how you can start to use that on a 24/7 basis.
I'd just like to, sorry, can you hear me? I'd just like to build on what you're saying, Jack. I mean, I think I agree with everything you're saying, and I would say it would be remiss not to talk about AI and what has changed since, 10 years ago. One of the areas that we do see great promise is in agentic commerce as well. And we already see a lot of co-development or innovation happening in public blockchains. That's also very different, where we see traditional regulated institutions now collaborating in public blockchains, thinking about how do we empower kind of the next generation of agentic commerce.
I think we're seeing the same things. As Jack mentioned, a lot of the domestic demand for stablecoins, the origination was the on-ramps to DeFi and crypto universe, which was fantastic. But now I think we're seeing a second wave of growth and acceleration as institutions look to integrate always-on stablecoin workflows into legacy infrastructures. I don't think that's going to happen overnight. It's going to take time. When you look at like the cable industry, for example, they spent a better part of 20 years and $500 billion upgrading from linear to video on demand and streaming. I hope it happens a little bit quicker than that for the financial world, but I think we're on a similar trajectory. So I do think that there's a lot of work to be done to make sure that these always-on, 24/7 instantaneous environments can work seamlessly for TradFi as well.
Yeah, and one of the things that I see when folks ask, like, do we really need more stablecoins? Is that market already saturated? Kind of tying in with the institutional focus as well, is I see a universe where we actually have, instead of co-branded credit cards, we have kind of the equivalent of rewards and loyalty programs that are tied to effectively co-branded stablecoins. And so that's something that I'm seeing kind of on both the issuer and reserve manager side, as well as on the brand side of how do we leverage this as a rail. Shifting a little bit, we've all kind of touched a little bit on Genius to the regulatory environment. The U.S. has historically been criticized in some cases as being slow to adopt fit-for-purpose regulation for anything in crypto, but including stablecoins. And yet, dollar-denominated stablecoins are what most people think about when we think about stablecoins. And so would love to hear from all of you, sort of what do you see as kind of the most important shifts as a result of regulatory clarity that we're getting, and why? Is it related to the institutional adoption? Is it related to importing across, on a cross-border basis, being able to do cross-border settlements? Would love to hear each of your perspectives.
Well, I think we're going to see a lot of innovation in stablecoin mediated FX solutions and correspondent banking over the next year or two. Obviously the pending adjudication of the question of stablecoin yield and affiliate yield is on the table for the market structure bill that everybody, I'm sure, is intimately aware of. But I think one of the more interesting points here is how the banking system is going to react to the acceleration of stablecoin adoption. There are a lot of differing perspectives on stablecoin promotion at banks, stablecoin issuance at banks, tokenized deposits. Also, if we get anywhere near the scale of stablecoin adoption that people are expecting, what the impact might be on the broader lending, especially commercial lending at regional and community banks. But also, I think that there's potential solutions for that as well. So I think that that's a real interesting area of development over the next year. And I'm excited to see how a rising tide floats all boats, because I think that there's a lot of scenarios where this works out well for everybody.
Sure. So one, I think we believe in the long-term promise of fast, instant settlement, but we're not there yet. So I think the reality is that there's still work to be done to deliver on that. I think, to your point, the additional complexity of everyone being able to create their own stablecoin, issue their own stablecoin, just mandates the need for cross collaboration. It's part of the reason why Mastercard has really this morning we announced our intent to acquire BVNK to facilitate that type of orchestration across stablecoins. In addition to that, we believe that it's going to take the entire ecosystem to innovate together to drive that on-chain economy, which is also why we launched a crypto partner program, because we know we can't go at it alone. And so I would just say, leave it to those 2 points.
Congrats on your announcement. We'll save the champagne until you close.
Exactly.
One thing that I think about as a result of Genius is really a shot across the bow around the world. I think regulators around the world very much pay attention to what the U.S. is doing. And to your point, Sarah, obviously the U.S. had been tagged with being slow to regulate, and a huge advance with Genius. I was in Europe a couple of weeks ago and meeting with regulators there, and Ripple has a global business. We have, I think, 75 or 80 licenses around the world. And so thinking about harmonization of rules, which don't exist today. They don't exist in the traditional finance world, but there's an opportunity given the passportless nature of digital assets and stablecoins specifically, and how that's going to work. And having conversations around our view, which is that stablecoins specifically, or private money is a term that people are using, can and should be really complementary to central bank money and to commercial bank money, and that there's a place for all of those. Obviously, it's a hot topic, and specifically in Europe, we care about it. We recently received a license in Europe, an electronic money issuance license out of Luxembourg, and we would like to issue our stablecoin RLUSD, which is a dollar-backed stablecoin regulated here in the U.S., but we would like that to be fungible in Europe the way it is in other jurisdictions. And Europe, through MiCAR, has very strict limitations around doing that. And this concept of a dual issuance is there really to allow fungibility and frictionless movement of that stablecoin. There's a lot of concern, specifically in Europe, around the exportation of the U.S. dollar and how you will manage reserves and whatnot. And I think that's an area that is getting a lot of attention. There's a lot of conversation happening about what guidance will come from the ECB, the European Central Bank, that will be handed down to the member states through the European Commission. And we've been waiting for that guidance for a long time, but the result of no guidance is that basically it's a standstill. And so that's a major economic zone that is somewhat cut off from the global stablecoin business. We could go and issue a separate dollar-backed stablecoin in the EU now with this license, which is something that we could consider doing, but it's suboptimal. And part of the conversation we're having is that we want to, because there's no central bank digital currency that is going to happen from the U.S. anytime soon, it's embedded into Genius, that the EU is going to issue a wholesale central bank euro, and that there's got to be a dollar companion to that, for cross-border payments or for European investors who want the dollar or vice versa. And so I think they're going to have to come to grips with how they manage and legislate that. Other areas that are meaningful economic zones, the UAE, much more advanced. Japan, we have an initiative there, so we'll soon have a stablecoin distributed in Japan, and there's a pathway to do that. Korea is opening up. I just saw the other day Australia opening up. So one by one, I think post-Genius, that regulators around the world, I think, are realizing that stablecoins specifically, and I think that's really the easiest digital asset for folks to get their head around for obvious reasons, is that it's inevitable, and it's a question of how you regulate it, not should I regulate it or not, because the cost of not regulating it, I think, is meaningful.
I think that's a really important point, and while you touch on the regulatory aspect of that, there's a strong technical aspect of that as well when you get into regional regulatory fragmentation as well as domestic verticalization. There's a pressing need for stablecoin interoperability, but there's a lot of wood to chop on that front, and I think we're going to see some innovative solutions over the next year or two to facilitate.
Yeah, maybe say another few words about that on interoperability, because I think maybe not everyone appreciates that it's part of this picture of having regulated, regulatorily issued stablecoins is you sometimes, for like Europe, for example, I think there's a requirement that you hold the reserves backing the stablecoin in the jurisdiction. But if you're outside the jurisdiction, that can have redemption problems, right? So if I'm here in the US and I don't have access to European banking rails, I would have a hard time actually issuing and getting my dollar out of the stablecoin ecosystem. And so there's both a sort of regulatory overlay, but also technological and just practical existing infrastructure. So I'd be curious, Glenn, in particular, as you, kind of what you talked about. What do you think? You said there's a lot of wood to chop there. Chop a little bit of it.
It's not. Well, to be clear, it's not Tassat chopping the wood. But you know, from an orchestration perspective, and as you mentioned, you know, making sure that you can work seamlessly across jurisdictions and different regulatory environments and different rules and regulations requires a lot of plumbing and orchestration. And I think we're going to see a lot of that built out over the next, 12 to 18 months. I don't know if you have specific perspectives.
I think, and maybe it's just my simple brain thinks about it in slightly simpler terms. I think part of it is education. So if we were to issue, just a simple example, 100 stable coins in the US and 50 in Europe, we use BNY as our global custodian. So that tells me that there's $150 in our reserve account, whether it gets deposited in the US or the EU, they ultimately funnel down to BNY. And each respective regulator wants to make sure that at any one point in time, if all 100 Americans or all 50 Europeans go to redeem at the bank, that there's going to be $1 there. And the reality is, that's unlikely to happen, but even if it were to happen, we have to deal with the challenge that some Americans may fly to Europe and redeem there or vice versa. And so at the end of the day, it's a pretty simple intra-bank transfer that would happen from BNY New York to BNY Luxembourg. And it might take a day, it might take 2 days. All of our SLAs for all the major stablecoin issuers have a 48-hour SLA. But as long as the bank is still standing and as long as, we've done what we're supposed to do from a regulatory standpoint of investing the dollars, there is a way around that. And what's not sustainable or practical is to keep $150 of reserves in the US and $150 of reserves in Europe. And initially, that's what some of the different regulators want to have happen. That's just not a sustainable business model. And so I think they're trying to come to grips with that. And there are all sorts of ideas that we've thrown out or proposals. While we could estimate, you could do a net redemption. I know that if there's been 50 issued in Europe and 10 have redeemed in Europe, then there must be 40 left unless somebody wants to move. And you get into the nuances of it. But I think if there's a will to making it happen, there's a way that we can come together and you can have increasing transparency around where the reserves are held. Everybody, every regulator should be able to see everything as far as I'm concerned. The challenge is that these stable coins or digital assets are not geotagged. So everybody wants to know, well, where is it at any one point in time? Who owns it? What are they using it for? I would love to know that. From a marketing standpoint or a business development, we would double down on what's working and pull back on what's not. But I think it will evolve over time. It's still early days, but I think there are solutions out there.
Yeah, just to piggyback on that, if all of this works at the scale that we expect it to, what we may see is programmatic capital velocities split off from capital storage and lending. We're not there today, but if we achieve trillions of dollars of stablecoin volumes, there needs to be an optimization on the reserve side that you were mentioning to make sure that all of this doesn't impact aspects of monetary policy and doesn't disturb commercial lending and reserve balances in a way that's detrimental. But I do believe that there are solutions, and I know we're working on some of that as well.
Great, thanks. And yeah, I think it's interesting thinking about the reserves and the regulatory overlay we didn't even touch on, and we'll have to save for another day. There's also the technological interoperability questions of on two levels, both what the market demands and what networks they want the stablecoin tokens issued on, as well as the question of what networks regulators are comfortable having those tokens issued on. And so there's a lot there as well that has to kind of fit together to make this all work. But shifting to the Genius Act specifically and thinking about what's ahead, we've seen a bunch of proposed rulemaking, requests for comment. We haven't heard or seen too much yet from states, but and I can't remember who mentioned it earlier, but the market structure is being actively debated now, including on the yield topic. So would love to hear from all of you sort of what your view of the world is today, and also just where do we go from here? What would you love to see if you had a magic wand that you could wave and have sort of one or a handful of additional regulatory points clarified in either the rulemaking or the market structure process? What would that be?
As a product person and working in the United States, it's really incredible to have this federal passport. But yeah, clarity from the state side would really be impactful in terms of knowing how to navigate. And then to your point, like how do we innovate in a secure and safe way? So for example, on the yield question, if we think about what's the future of loyalty, can we start now embedding that into our products and services? That would be super helpful.
Yeah, it's kind of like cashback rewards, cards, things like that.
Yeah, I agree. I mean, clearly the global harmonization, if I had a wish list, that would be one of them. But also we need to solve for this yield issue, which is really the crux of what's being debated right now in the Clarity Act. And I do think the banks have strong views. I think there's this thesis out there that stablecoins pose a threat and all, bank deposits are going to leave the banks and banks won't be able to lend anymore and the trickle-down impact. I just don't think that is grounded in any sense of reality. I heard a quote the other day that people are more, I think the stats are higher, you get divorced than you actually move banks, or move your bank account. People are it's a very sticky relationship that one has with their bank. And I think that there is this complementary nature of stablecoins. And if the banks want to be in the stablecoin business, they should get in the stablecoin business. There are inherent advantages that already exist in Genius for the banks to do that. And so if they want to enter the space, they should do it.
I'm not sure there's anything further to add, but yeah, it's obviously the adjudication of the yield question is paramount right now, and just being able to validate real-time visibility into the reserve backing to make sure that everything is operating as it's supposed to.
Yeah, one thing that I've thought a lot about with the kind of reserve question, and Jack, you mentioned the notion of the banking relationship being sticky, and this notion of the rationale of prohibiting yield relates to sort of this idea that there might be some kind of flight on bank capital effectively. But I'm curious if you all have seen or thought about how are the banks themselves thinking about this? Because one thing that it seems to me, or at least if it's happening, I haven't seen it or heard it, but it seems to me like there should be a dialogue, not at the issuer level, but at the underlying bank level, because a lot of the issuers of stablecoins right now are not actually the depository institutions, and maybe where we need clarity is at the level of what can the banks that are behind the issuers do. So curious if you're having any of those conversations or thoughts on that.
Yeah, I mean, we need banks as an industry more than banks need us in some ways. And so we have very strong relationships with lots of banks that help us from a transaction standpoint, from a reserve management standpoint, from a custody standpoint. We want to partner with them in their cross-border payments businesses. So I think it's a very powerful partnership to be had. Whether or not, to your point, the banks want to actually go and issue a stable coin, that gets into a broader interoperability. Does JP Morgan want to take the Citi coin? Does Citi want the HSBC coin? I mean, you can see how that would be challenging. But I think that there's a meaningful role to play for banks, and they're just, I think, in this transformative stage of trying to adapt to a new world order. I mean, basically digital assets, I think we're rewriting a new operating system for capital markets. And so there's a bit of an identity crisis going on with all of us, including the banks, to understand what their future role is.
And banks, I think, are still debating, should it be a stablecoin, a tokenized deposit? When is the right use case for either of them?
I think that's right, and I think that there's room for everybody, and I think a rising tide should float all boats. I agree with both of those statements, and Jack, what you were saying before about the real risk to banks here, I think has been overstated, and I think that there's a lot of alignment that can be created, yeah.
And how are you thinking about, because Maja and Glen, before we hopped up here, I think we were chatting a little bit about, tell us a little bit more how you're thinking about the difference and distinctions between tokenized deposits and stablecoins.
I don't know if we have enough time for that.
Lightning round.
I'll give you the floor.
Banks are really trying to get their heads around right now, or at least the banks that we're talking to, as Maja was saying, what the use cases are for tokenized deposits versus stablecoins. And Tassat's been a player in the tokenized deposit space for going back to 2019, and we've seen various ebbs and flows and interest. Intrabank tokenized deposits, interbank tokenized deposits. Are they really deposits? Are they, representations of liabilities, which technically they are, that need to be settled out on a periodic basis? I think that there's a lot of interest in creating interbank consortiums to offset some of the larger bank efforts. And I do believe that there is room for tokenized deposits to succeed although they don't benefit from the natural use case and product market fit that has driven the early adoption of stablecoins. So I think that banks have to be thoughtful about the verticals that they're targeting and how they build out that infrastructure. It also takes a fair degree of operating discipline to operate a 24/7, 365, always on, never goes down, tokenized deposit network. And I think, there's some work to do to make sure that the infrastructure can support that.
Great. Well, thank you. We'll have to have our whole panel on tokenized deposits next year. Thanks, everyone, for your time, for being here, and thank you to my panelists.
Thank you.